Your broker shows you an expected move before earnings, plus or minus 8%, plus or minus $12, and almost everyone reads it as a forecast, a target, a hint about direction. It is none of those things. That number is the options market openly admitting it does not know where the stock is going and putting a price on its own uncertainty. Today, I want to make that feel obvious, so the next time you see it, you read it correctly in about 2 seconds. This matters right now because we are always weeks away from another earnings season, and earnings is when the expected move is largest and most abused. Before you buy a call because a stock might pop, you need to know what you are actually paying for and what the market has already baked in. Quick and important note. This is educational commentary, not personalized financial advice. I am walking you through a mental model, not telling you what to trade. Here is the wrong belief almost every retail trader holds. They see expected move of 8% and think, the pros expect this thing to move 8%, so if I think it moves more, I win. That framing quietly assumes the number points somewhere. It does not. Let me show you where it actually comes from, because once you see the machinery, the misconception dies on its own. Take the simplest case. A stock trades at $100. Earnings are tomorrow. You look at the option that expires this Friday and you buy both the 100 call and the 100 put. That combination is called a straddle. Say the call costs $4 and the put costs $4. You just paid $8 for the pair. That $8 roughly is the expected move. On a $100 stock, that is plus or minus 8%. It is not a survey of analysts. It is literally the price of the nearest straddle. So what does that $8 actually mean? Here is the part that reframes everything. The expected move is roughly one standard deviation. In plain English, the options market is pricing that about 68% of the time the stock lands inside that band by expiration. 68%. That is a little better than 2 in 3. It says nothing about up or down. It is a range of doubts centered on today's price, not an arrow pointing at a destination. Let me make the number concrete. Stock at 100, expected move of $8. The market is saying, about a 2/3 chance the stock finishes between 92 and 108. That leaves a full 1 in 3 chance it finishes outside that range, either below 92 or above 108. Not a freak event. 1 in 3. So if a stock blows through its expected move on earnings, the options market was not wrong. It told you that happens roughly a third of the time. That tail is where retail gets emotionally destroyed. A stock gaps 12% on earnings, people scream that nobody saw it coming. But an 8% expected move implies moves beyond 8% are normal and frequent. Here is the durable handle I want you to keep. The expected move is a band of ignorance, not a bullseye. When you catch yourself treating it like a target, stop and remember it is one standard deviation of we don't know. Now, why is that straddle so expensive right before earnings in the first place? Because implied volatility is jacked up. The market knows a news event is coming and inflates option prices to compensate sellers for the risk. The moment earnings are released, that uncertainty resolves and implied volatility collapses. Traders call it the volatility crush or IV crush. This is the trap. You can be right about direction. The stock moves your way, and your call still loses money because the volatility you overpaid for evaporated overnight. So the expected move is really a break-even line for the person selling you that straddle. If the stock moves more than $8, the buyer wins. If it moves less, the seller keeps the premium. That is the second aha. The expected move is the market's fair price for the event, the point where buyers and sellers roughly break even. When you buy options into earnings, you are not betting the stock moves. You are betting it moves more than the expected move already implies. That is a much higher bar than most people realize. One more layer because the band is rarely perfectly symmetric. Compare the price of puts to calls at the same distance. If downside puts cost more than upside calls, that is skew, and it tells you the market is paying up for protection against a drop. It does not predict a drop. It tells you where the fear is priced. Reading skew is how you go from how big is the move to which side is the market more afraid of. That is genuine signal, and it is sitting in the option chain for free. So what does a disciplined trader actually do with this? First, before any earnings trade, they find the expected move and ask a real question. Do I think the stock moves more or less than this band? That single question kills most bad trades because usually you have no edge on it. Second, they compare the implied move to how the stock has actually moved on past earnings. If the stock historically moves 5% and the market is pricing 10, options look rich. If it usually moves 12 and the market prices 6, they look cheap. Third, they respect the crush. They know a long call needs a move bigger than the expected move just to break even. And here is where this transfers beyond earnings. Every options price you ever see contains an implied move for its expiration, not just around earnings. Weekly SPY options, a Fed meeting, a jobs report, a biotech data readout. The same math applies. Take the straddle, that is your one standard deviation, that is the 68% band, and roughly a third of the time price finishes outside it. Once you internalize that, you stop reading option prices as forecasts and start reading them as ranges of doubt with probabilities attached. That is the whole game. If this made the expected move click into place, subscribe. This channel is about signal, not hype, and I break down what the options market is actually pricing before the big events so you can size risk like an adult. Next time your broker flashes plus or minus 8%, you will not see a forecast. You will see a two-thirds band of doubt, a break-even line for the seller, and a bar you have to clear to win. That is what the options market is really telling you.